All right, so I want to finish up what we started last. We were at the end of last class. So I was showing you this person planning for retirement. She invests an amount growing with her wages. And when she turns 62, she starts withdrawing money. She stops investing. And then when she turns 95, her life expectancy, she essentially runs out of money. Kind of somewhat dangerous. That's called longevity risk. We need something that's going to keep paying no matter when she dies. So that's what the immediate annuity is. That's your article. That's your third article for the first paper. The problem with immediate annuities is you don't get as much bang for the buck as you could. So an immediate annuity, you give them 500,000 bucks and they pay you $500 a month for the rest of your life. It's just not all that powerful. Not like life insurance. Life insurance, you pay a premium of $50 or 2 or 3 months. If someone dies prematurely, they're getting $1 million and all they paid was a few $100s in. It's really skewed. So can we find a way to take that heavy skewing that you see in life insurance and put it into the annuity side? And so this is the product I think makes sense. Now, the longevity annuity, that the investments look different because remember I did it as one investment for all years, and the other one I did it starting low and growing. I just didn't update this one. I could have done it. I just need to update it. But it's the same. She invests, and by the time she turns 62, she'll have 1.7 million. But she's also going to do a longevity product. Now, if you type longevity annuities into Google, you're going to find some products. I think they're horrible. So this is the product I want to do. So she thinks she has a portfolio that's going to make it to 95. If she turns 90, 91, and she's still very, very, very healthy, now she's got a dilemma because this portfolio runs out. Is there something we can do like life insurance, but the exact opposite? With life insurance, you die prematurely, you get your family gets this massive payoff. Can we have something that only those people who live a long time get a massive payoff? And so that's what this longevity annuity is. So what she's going to do, she's going to invest that amount to get her to 1.7 million, but she's going to take $25 a month and put it into this longevity product. The way this product works is the insurance company invests it. It's her money with one caveat. She dies 1 second before her 90th birthday. She gets nothing. So the question is, what will she get when she turns 90? So what will she get? Well, she'll get all the money she contributed. What else will she get if she turns 90? She'll get all the money of whom? The people who died early. How powerful is that? Now, we know with life insurance for young people, if a young person dies early, they get a massive payout. Why? Because so few young people die early. Well, how many people might get to 90? Not that many. And so there's a large number of people that are paying that $25 a month that aren't going to get it. She gets to keep all of that. All she has to do is live. It's a lot nicer than life insurance, right? How do you get the life insurance? You got to expire. But this is kind of nice. The only qualification to get this massive payoff is just to live. So the only question is, how massive is the payoff? Now, I use the 1980s CSO mortality table. You might say, well, that can't be right. I'd use the life table instead of the annuity table. With this problem, it's hard to know how much that mortality table skewed it, because more people are going to die on that table. So I'm going to be losing a lot of $25 contributions because more people are dying early. And so it's hard to say. I should update this with a more current mortality table, but I just haven't. It's going to be in a ballpark. Maybe it's 20% higher or lower, who knows? But it's going to be in the ballpark. So here what she does is she invests $25 less than she did with the other strategy. Now she's going to notice, this is the key to my product, what I was trying to get patented with USAA. The key is I've combined this annuity with an investment program. She's investing $1,300 or $1,350. We're taking 25 of that and setting it aside. Is she going to notice that $25 that's being taken from her? And my argument is going to be no. It's going to be such a small amount. She needs to start young, be a smart amount, but we set this aside for her. It's her product. And All she's got to do is live to be 95, 90 years old and she's going to get it. So she's investing, she's investing. You come along to age 62, she's still got 1.7 million saved up. So that $25 she put aside didn't really hurt her portfolio that much. Then she starts, everybody's with me so far, right? She's done everything she did before, except for putting $25 aside in this special annuity. Then she starts taking money out. So if she makes it to 90, she's going to get these people's money. So how much is that money going to be worth? Any guesses? $1,000, $10,000, $100,000? What would you guess? $25 a month. She stops paying it at 62, so she only pays in for 37 years. And no guesses?
So she gets what's at the end of ending portfolio time?
Yeah, so if a million people buy this product, all the ones that died, their money go to her.
What goes to $500?
$500,000, all right. Let's see. Oh, there it is. 1.9 million. So plus or minus 20% because I'm using a raw mortality table. It's not going to be that far off. What is 1.9 million going to do for her? Remember at 95, she was starting cocaine or whatever, but now instead she's got 2.2 million. How long can she make it on this? Now, if she's healthy at 110, 112, yeah, she's got something to worry about, but it's going to make it to 113. That's pretty impressive. So the actuary said she never buy it because she could lose 100% of that $25, but they're thinking of it as a sole product. She's buying this product and she dies from getting that. I'm combining it with the investment program. So it's just kind of part of it. We just tell her, hey, we're trying to maximize your income in retirement. We're going to take a little money aside in case you live too long. I don't think she's going to notice it all that much. All right. So that's my idea. I wish someone would create it. I like the idea. So how do longevity products work? What they do is they have people start investing way too late, like in their 60s or 70s, and it starts paying them a monthly income at age 80. There's not enough people dying. You got to get a bunch of people dying for this product to make sense. So you got to start it pretty early when she's 25 or 30 or whatever, early on, because you need a lot of the exact same thing with life insurance. So what it doesn't make sense for her to buy this product. What doesn't make sense for her to buy life insurance at 25 either, because she's very unlikely to die. So remember what we said in that third article, or that article you're not doing, but that bias, that framing. If we can think about longevity annuities as a maximizing your income in retirement, no matter how long you live, and not as an investment, I think it works. The actuaries were thinking of it as an investment product that no one's going to buy because it's you can lose 100%. Would you want your parents to buy this? Would this make sense? What's the chances of them moving into your garage? It's pretty low, isn't it? Remember with the other situation, what is her family hoping for? Around here. She's got dementia, she's on the lip, she doesn't remember anybody, or like, oh, man, if she would just die, we at least get something. And and if she lives too long, we're going to be paying for all of her expenses, right? They're starting to worry that they're going to be paying $13,000 a month. They keep her in assisted living. Pretty brutal, right? It's a horrible thing to do to a family to say, man, we don't want to wish someone would die, but we can't afford if she lives. She's really not having much of a quality life. We're going to talk about end of life when we get to healthcare. It's a horrible, horrible issue you have to talk about. It's one of the most awkward things you have to talk about in the second paper. What is her family doing right here? They want her to live for good reasons. Now, maybe 2 minutes after her 90th birthday, they may not care as much, but here they're like, come on, grandma, make it one more day. They may do I don't know, Weekend at Bernie's. How many know that movie? So they might do a weekend at Bernie's, right? That'd be kind of morbid, but yeah, prop her up, make her look like she's alive for 2 more days. It's a very different mindset for the family. It takes you see how, we saw in that article from the Chicago school. you know, the family, you either buy one of these products and the family gets less inheritance, but then you take the risk away from them. And this is essentially what you're doing. You're taking the risk of your longevity, not just away from yourself, but away from your family as well. So they become an active celebrating that you made it to 90. They're probably going to be your biggest birthday party ever is your 90th birthday. They're going to be, wow, that's great. Wonderful birthday. So I love it as a product. I think the big trick here is you got to start early. 25 might be too early, but you got to start at 30s or 40. You know, really get the kick out of it. It's got to start pretty early.
And that 1.8 million, I'm assuming that she's the sole survivor of that.
No, not the sole survivor. She's just following the mortality table.
Somebody who made it tonight. So
Of the percentage of people making it to 90, they all get the 1.8 million.
Okay.
The percentage who don't make it to 90, they get nothing. I can tell you the percentage. I think I have it over here. I forget where I put it. There's somewhere in here I have the mortality table, but I may have hidden it. Yeah, somewhere in here is the mortality table. But yeah, I have the actual mortality table. So people are paying premiums. As they die, the premiums go down because there's fewer people paying the premiums. The premiums stop at age 65 or 62. After that, as people die, there's just that that's it. There's nothing for them to do. They don't pay more premiums. They don't receive anything. It's only the percentage of people still alive at 92 or 90 that get this. So she's not getting everybody's money, but she's sharing it with, you know, for 100,000. Well, I can probably show you.
There like a minimum number of people in the pool that have to.
Well,
program to be successful?
It's got to be a popular product for it to work, no question. And so that's the other thing. But the third article that we didn't do for the paper, they talk about these new products offered by the industry. It's usually an investment firm doing something with an insurance company in a single combined product. And I think that makes sense. I would just design it very differently. So we have a mortality table in here. No, I haven't put the mortality table out there yet. So I'll show you mortality here one of these days. Maybe I can find it from last semester.
Not the one in the Excel spreadsheet.
Oh, is there one in the Excel spreadsheet? Oh, there he is. Thank you. All right. So you start with 100,000 people. Only 6,000 are still alive, 6,700. So 7% get the money from the other 93%. You can't create that with any other product. Life insurance has that advantage. They just have not decided to do that on the longevity side for some reason. I think it makes a lot of sense, especially if you have an American population that's not ready for retirement. I think that kind of sharing is like, you know, most of you are going to get nothing, but the few of you that do live too long, you're covered. I think that's comforting to the entire group. You know, that just makes a lot of sense. The same thing with life insurance, right? Most of you can get nothing, but the few of you that do die early, your family's going to be taken care of. It's the exact same mentality. For some reason with life insurance, we're perfectly fine with it. But with annuities, we don't. Why? Because when we heard the word annuity, we think investment. We're in that investment mindset, not in the risk management and consumption mindset. So yeah. And you'll notice that it triples or more than doubles if you just wait 3 more years. So you can decide how much bang for the buck you're going to get. So if she comfortably makes it to 95, she could push that back to 94 and pick up not 50% more, but 100% more, 200% more. When you get into the 90s, it starts dropping pretty fast, right? Not many people,
But if she dies at 94, does it just go to the estate at that point if she's chosen to purge?
Well, if she makes it and gets the amount, yeah, it goes into her estate. It's life insurance, so it's tax-free, which is kind of nice. So yeah, I mean, it's an incredible benefit to her family. Yeah, I don't think the life insurance industry has really thought through how to take advantage of mortality table on the longevity side. It just haven't tried it. Would you buy this product? I guess that's what I ask. Any of y'all buy this product? Or are you just too young to carry it? It takes some good marketing. You'd have to set it up right so that people understand. I think the problem with our industry is that we charge way too much for this stuff, and so the fees just look horrible. It's got to be a good product. I tried doing good products where I used to work at USA, and there's like, wow, it's a really good product. We should do it. So yeah, we're going to charge 100 basis points. Like, no, it's not worth that, but it's a really good product if you don't overcharge for it. So that's the problem. We charge way too much for our products. All right, let me end up on the ethical challenges. So remember we said last time, this industry used to just be basic life insurance, whole life and term. And then interest rates rose, the stock market took off, and they said, wow, a lot of our money is moving to banks, moving to investment firms. We should just downsize, cut our losses, be a much smaller industry. And they said, you know what? No, we're gonna become asset gatherers, just like the banks and insurance companies and investment firms. We're gonna do exactly what they're doing. We can make a lot of money doing that, but we got a problem. We're way too expensive. How can we get around this? Well, the one thing we have that banks and investment firms don't have are commission sales agents. What if we give really complicated products to overly incentivized commission sales agents and see what they can do? And guess what they did? They did a really good job. They were able to sell these horribly complex, overpriced products because they have that sales agent. And so product complexity, the hard sell, difficulty comparison shopping. We're going to get into that in detail when we talk about the equity-linked annuity, which is my least favorite product. So just to give you the Doña story. So Doña, she's a lady at my church. My preacher would call me to do, I did a lot of pro bono. So he called, I got so-and-so in my office, she's in tears. And I, without even another word, I go, well, what life insurance product did she buy? Because I just knew it was life insurance. It wasn't investments. It was always the life insurance. Sure enough, Donya's in his office. She's in tears. So, and sweet lady, Doña, just sweet as, if you saw her, she'd be just the poster child for the grandmother chocolate chip cookies and, just the sweetest lady. She had one son, but her husband passed away early in her marriage. So she was a single mom raising this kid with I did her taxes one year. She was not a wealthy woman, but she gave all her money to an insurance company. And at the end, she had saved up over $100,000, which is pretty impressive. And they had this in an annuity, which is this insurance. I won't mention the name of this company. I'll try not to mention the name of this insurance company. It's a pretty major one. And it was a good product. It wasn't a horrible product. It was a fixed annuity. She was saving tax deferred, decent product. And it's pretty impressive, right? Someone like that saves up $100,000. That's pretty impressive. She didn't have a 401k plan or pension plan, working very low paying jobs. But she's in tears because the sales agent said, you're getting close to age 70 and you have to annuitize, which is a piece of cake. You just annuitize. What that means is you got to pay out a certain percentage of every year so she can pay tax on it. But that's not what he did. He sold the entire annuity, making the entire thing taxable immediately. And he stuck it into another annuity where guess what he got for that? Got a commission for that. So she's in tears because she now owes $10,000. This is the woman who had very low income. She now owes $10,000 in taxes, and she doesn't know what to do. He shouldn't have annuitized. He shouldn't have sold it and bought. He should have just annuitized. Then she'd only be paying tax on a very small portion of it. Instead, she has to pay tax on the entire amount. So she's in tears. What do I do? And so I'm looking at that, and it's like, why did he sell? I was teaching a financial planning class, and I told them what he did, and go, why did he do that? Yeah, that's like financial planning 101. So she doesn't understand this business. She's upset, obviously. She was going to go visit her son, and he's in Hawaii. She hadn't seen him in years. Now she can't because she's got to pay $10,000 in taxes. Her son, by the way, passed away from cancer a couple of years later. So, he's got some sicknesses. So she's in tears. So I go with her to her agent. All right. And I may not seem intimidating, but I can be really intimidating when I want to be. And I was intentionally as intimidating as I could be. And so I scared this guy to death. And so here's what he said, if you can believe this. He said, my company poorly trained me, and that's the reason I did it. And I had him admitting that in front of me. And so I wrote a letter, and it's something you should always do with life insurance companies. You don't write a letter to the company, you write a letter to the president of the company. It becomes a presidential complaint. So they didn't answer, so I called them and they said, well, we ignore the first one. So I sent the second letter. And on that one, they agreed. And here's what the lady said. The guy I was working with was emailing me from his desk right behind me saying, Ron, can you talk a little more softly? Because the entire bay is looking at you. We're in this major room and because I was talking so loud, I was so mad at this person. But she said, we've decided to send her a $10,000 check because the agent said he made a mistake in your presence. If he had not done that, we wouldn't be paying you anything. But here's what they said. It was her fault. She should have consulted whom? Her tax attorney. Guess how many tax attorneys Danya has? How many tax attorneys she's even met in her lifetime? None. She doesn't have a tax attorney. When they sold her the product, what did they talk about tax attorneys? They didn't say anything about tax attorneys. Does it make sense for this sweet little lady with, limited income, limited education that they would expect her to have a tax attorney? But that's what they told her. She should have consulted her tax attorney. It's not this company's responsibility to manage her taxes. She went to her agent and said, what do I do? And he did it all for her. She didn't ask him to do that for her. So very frustrating. The problem with the $10,000 was they said, we'll send you a $10,000 check, but she has to sign a form absolving us of any liability for any product we ever sold her. They also sold her a life insurance product, was a complete ripoff. I don't know why they sold it to her because she had no dependents. And I wanted to sue them over that. So I didn't want her to sign the forms absolving. So the only way they give her the $10,000, she did that. So she's asking my opinion. I said, I'm not a lawyer. I can't help you with that. So we went to a pro bono lawyer, asked him, what do we do? Because I thought she could sue and probably get quite a bit of money out of him. But she just wanted the money because she wanted to go visit her son. So I don't know if you want to guess what the pro bono lawyer recommended she do. Any guesses on that? So this pro bono free lawyer, right? Get all this free legal advice. He told her she should go hire a lawyer. So that was his advice. So I'm not giving any legal, and she just keeps saying, no, I just want the 10,000. I'll sign the form. I said, you got to do, I'm not giving you any advice. I was tempted to say, I'll give you the 10,000. Let's sue them and you can reimburse me because I think you can win this lawsuit because they should have never sold her that life insurance. That was a complete waste of her money. She had, who's going to benefit from someone with no dependents in their 70s with life insurance? There was no reason to do that. So she took the 10,000. I actually got more than 10,000 because I divided the 10,000 by 1 minus her tax rate because I wasn't sure if it was going to be taxable or not. So, and they bought it and they sent her the money. So she took the money and then visited her son, and her son actually visited her a little after that. And he was like, I'm so glad you're there to be there for her. But I mean, think about this industry. What if I hadn't been there or someone else hadn't been there, like, willing to go intimidate this guy? What would she have done if she were completely by herself? It's pretty hopeless, don't you think? She didn't have someone that could go help her. And most people don't. They're just at the mercy. When I did her taxes, I think her income was less than $1,000. I mean, it was just like, she didn't have money to pay $10,000. The funny thing was, to pay the $10,000, he said, well, we can take it out of your life insurance product. And said, well, if you do that, that's going to be taxable. It's going to create this loop. So he's going to create another taxable event by paying for this tax mistake he made by taking money out of the other product. It was just a mess. Now, do you buy his story that he was poorly trained? Or do you think he was overly incentivized? So he did what's called churning. He sold a product, put another product so he could get the commission. It's heavily frowned on in the industry. But his argument was, I was poorly trained. He was pretty well seasoned guy. He's in his 50s or 60s. He's been working in this. I have a tough time believing he didn't know you don't sell a product like that and pay 100% of the tax on it. I do. I mean, it sounds sinister, but I do believe he was thinking commission the whole time, and that he get away with it because what is this poor lady going to do? He didn't know I was going to show up and be the bully. I don't like bullies. One lady complained, man, he's such a bully. I'm only a bully to bullies. I'm not a bully to non-bullies. So I was a bully to this guy. So that's the industry. Do I hate this industry? I hate that part of the industry. I love this industry because it sells products I think are really, really quite valuable, and we'll talk about them. This part of the industry I don't like. So what can you do to protect yourself? One of those things, well, we'll get into equity-linked annuities, but one of those things is to get into detail on the tax consequences. And you need to get in writing, if I have tax problems with this later, what is your company going to do? And they're going to have to confess up and say, we're not going to do anything. You're on your own. And say, well, how complicated is this? Life insurance is a very complicated tax product. It has a lot of bells and whistles. The IRS gives a lot of, I think we talked about this earlier. The IRS gives huge tax advantages, but they take away a lot of liquidity. I mean, these products are very tough to get out of. So the IRS says, okay, we'll give you this tax advantage, but if you change your mind, it's going to be painful. So you better know what you're doing up front. The insurance industry doesn't tell its customers that. They sell them the product like, oh, a piece of cake, you're going to love it. It's going to be all wonderful. They never say, hey, if you change your mind, it's going to be a tax nightmare for you. So that would be good to know up front on these products. Now, she bought a deferred annuity, very simple product. It was actually a decent product. She didn't buy one of the complicated ones. And that's how bad it blew up on her. So you can see how this industry can really, really mess things up. Any comments on that? This is the exam question. There is a rubric for the exam question I'll show you. So, you might want to start working on that and start thinking about it. Students lose a lot of points on this because it's way too summarized. I need some pretty intense detail. So I've given you quite a bit more than what's in the class notes. So you might have to go back and listen to the class video. Anybody want to defend the industry? Did I overstate the case? Anybody work in this industry or has worked in this industry? So should you work in this industry? There are some horrible, horrible companies. There's some great companies that have some bad stuff. So this company that did this to her has some good stuff and some bad stuff. There's some much better companies out there. I do like USA because they don't have sales commissions. I think that by itself protects them quite a bit. But we'll talk about the products that I think are good. I think there's some products they sell they should just stop selling. I just think they're really that bad of a product. At USA, they're thinking about starting to sell the equity-linked annuity. And I said, you sell this product, I'm quitting. But I'd already announced my retirement, so I didn't really have much teeth. But I hate that product. And their argument was, yeah, it's a horrible product, but ours won't be as bad as the competition's. And it's like, why should USA ever sell a bad product? You're owned by your customers. And like, well, everybody's buying these. They're really popular. It's like, yeah. Should a company sell a product that's popular, even though it's a horrible product? I would say no. You should somehow convince your customers this is a really horrible product. You're getting ripped off. But it's a tough industry because of the complexity. All right, so let me more badmouth this industry before we get on to the good stuff. So here's a lottery winner. What was the story about that? One couple won the lottery, but somehow it didn't get mailed in correctly. You'll see that here recently, or something got messed up. But yeah, that's kind of bad when you think you won a massive lottery and something got lost in the mail. But this guy won the lottery. So if you win the lottery, what's the first thing you would buy? Maybe a new house, new car. Maybe you put some away for retirement. Life insurance. How much life insurance would you buy? You just won a massive, massive lottery. How much life insurance? Well, that's all he bought. A young, unmarried grocery store worker. So how many dependents does he have? He won $336 million. He bought $100 million life insurance policy. Now he's suing his financial advisors who sold him the policy, along with other investments that encouraged him to assume tens of millions of dollars in debt. That whole sentence makes no sense, does it? You're thinking, how stupid could this guy be? But again, you've got a commission agent, sounds sophisticated. People, when someone's talking to you like They pretend like you should understand, and they know you don't. People just they'll say, "Oh yeah, I see what you mean," and they'll do stupid stuff. So he won the lottery in 2009, taking a lump sum cash payout. So he got 70 million after tax. So that's quite a bit of a difference. Shortly thereafter, he began investing in two financial advisors who are also attorneys and insurance agents. Um, you got three professions there. I kind of badmouth quite a bit. I just badmouth an attorney, not agents, and now you got financial advisors. But it's not that these people are evil; it's they're horribly incentivized. That's my whole thing is incentive. We'll talk about that with healthcare. It's the incentive. It's not the product. It's not the people. It's the incentives that make them do things like that. They advanced him to buy 4 policies from 4 companies, telling him he could earn 50 million by the time he was 50 years old. He says the agents made $1 million in commissions. That's a pretty good commission. You could essentially sell one product in your life and you'd be done. Exploiting the fact that he knew nothing about life insurance. He said he had no need for so much life insurance. He stood no chance to benefit the insurance financially since he was not named as a beneficiary of the trust that owned the policy. I'm trying to figure out if they said this or this is what he remembered them saying or exactly what. I had some friends who did something like this and I didn't know what to say to him because they really made a mistake. But he was like, yeah, this is really good. And I'm thinking, you're talking about like it's a really good investment, but you know it's life insurance, right? You have massive life insurance premiums. And his wife's like, yeah, I'll make a fortune if he dies. Like, yeah, that's true. But what is his benefit? He's talking like this wonderful investment. Life insurance is not an investment. It's you're paying premiums that's going to pay for your death. There is a cash value, but you're still paying the premiums and that's coming out. There's no way you can do as well as an investment because a lot of that money is just going to pay for the life insurance. There's no magic here. So yeah, I don't understand even what that means. And this is really confusing to me. If he's not the beneficiary and there's a trust, then who's the beneficiary? If it's a estate and he has no estate, he has no wife, no kids. So there's a lot of uncertainty. Wouldn't you love to see a video of this sales pitch and hear exactly what they said to this guy? It'd be really interesting. 2 years later, the defendants attempt to persuade him to exchange his existing life policy for a single $600 million policy. He learned that his existing policies were highly unsuitable for him and were funded in a way that would provide him no potential benefit and would leave the trust liable for large amounts of gift tax. That doesn't make sense to me either. The claim says he finally surrendered policies after paying $2 million in premiums. He is seeking damages. I should look up and see if he won his case. I don't know. I haven't seen, the result of that. So is he stupid or is he just taken advantage of by these sophisticated salespeople? If they got a $1 million commission, that's a pretty good incentive for them to stretch the truth quite a bit. And none of it's being recorded, none of it's down. So it's going to be his word against their word. So, it's kind of scary this goes on with the industry. So I tell people I won't give you advice on life insurance, but well, if you buy something from an insurance company, show me what you bought and I'll tell you if I think it was stupid or not. During the grace period, so you can get rid of it and go back because you usually have a 10-day or whatever period where you can change your mind and go back. So I've told people, like especially my brother, it's like, okay, so you feel guilty not buying something, so buy it and then we'll cancel it 3 days later. Then you won't have to see them when you cancel it. And then, you made them feel good when they left your house and then you canceled it. So you're no worse off. Let's do it like that because it's just, the incentives are horrible. All right, there's the papers. We talked about those. All right, so you're ready for life insurance? Any of y'all have relatives that work in this industry? And if you want to bring someone for the public debate, bring them on. I'll take them. All right. So we're going to start off with life insurance, the type of life insurance that there is. advantages, disadvantages of each type. So life insurance doesn't insure against death, it insures against premature death. So you have to remember that when we're talking about products like whole life and those type of things. Property insurance, you can have 4, 5, 6 claims in your lifetime. Life insurance, supposedly, you can only have 1 claim in a lifetime. Is it possible someone has received life insurance payouts more than once in a lifetime? And it is. There are actually cases, I should find one and show it to you. The most common case is someone goes missing in a dangerous situation for 7 years, and after 7 years, you're just presumed dead, and they show up 5 years later, they don't have to get the money back because they were presumed dead, and then they can buy another life policy. Not too likely to happen, but it's possible. So insurance is not, life insurance is not a contract of indemnity. They're not trying to bring you back to where you were before the loss. They're just providing compensation to try to offset that human capital. All right, so a few terms we need. Insurable interest. More important for the P&C side, but it can be important to life insurance. So the person buying the policy prefers that the one whose life is insured remains alive even after consideration of the insurance proceeds. So insurable interest on auto insurance, you can't buy a car, buy insurance on it, and then sell it to your 16-year-old neighbor and keep the insurance on that car. Because you don't have insurable interest. You don't care if he crashes it or not, or you hope he crashes it because you get the insurance. So insurable interest is you, even with the insurance, you prefer not to have a loss. Life insurance, that's pretty obvious if you're insuring your own life. So we kind of assume you have insurable interest in your own life. So if you're both the insured and the policyholder, the insurance industry says, okay, you have insurable interest in your own life. There's no legal limit. If you want to buy $3 billion of life insurance from 500 different companies, you can do that, and they will all pay. Unlike health insurance or auto insurance, a lot of those policies, there's a primary and a secondary, and they're not going to keep paying you over and over again. But life insurance, there's no limit because it's very subjective what your life is worth. You decide that. The insurance company doesn't decide that. So you can put whatever value you want on it. If the insured and the policyholder are not the same, there has to be insurable interest. But the strange thing with life insurance is insurable interest only has to exist when the policy is issued. Unlike auto insurance, once you sell the car, the insurance stops. Even if you keep paying the premium, you think you got coverage. Once you sell it to another driver, the insurance stops. Once your insurable interest stops, the coverage stops. Life insurance, that's not the case. So 2 people can be married, have life insurance on each other, and there's this horrible divorce. They leave, they hate each other's guts. They've even said, I hope you drop dead. They can continue the life insurance on that person. Now, if they murder the other person, they're not covered then because that would be illegal. But if the person dies, they don't have insurable interest necessarily, but the policy is still in force and still covered. I think the main reason for that is the complexity of insurance and all the tax rules. Insurance is, unlike auto insurance, you just stop paying the premiums. With life insurance, you got this product that's been building up, and it's just a tough thing to just say, hey, you got to stop that premium now. If you are insured, if the person insured is not the policyholder, you usually have to have the person whose life's insured sign the policy so that the insurance company knows their life is being covered. I mean, what would you think if your neighbor who just moved in comes over and says, hey, can you sign this policy? I just bought $1 million life insurance on you. Make you pretty nervous, right? So they want to at least have your signature so you know about it. Now, those ladies that were murdering homeless men, they were getting them to sign, but the men didn't know what they were doing. You know, a lot of them had serious mental health. So they were just buying these policies. It was pretty obvious after the fact that they were the murderers because these 2 women had these policies on all these men they hardly even knew. They were just men on the street. But they did get their signatures. They just didn't know what they were signing. They went to jail, so they got caught. It seems like it was obvious they're going to get caught, though, doesn't it? You know, you see these people dying in the street, and you're like, oh, wow, they all have life insurance with these 2 ladies. That's kind of interesting. They all died in the same, you know, the statistics are not on their side. All right, so that's insurable interest. Anti-selection, adverse selection, extremely important for life insurance and health insurance. And what that means is people who are more likely to need the insurance are more likely to buy it. So unhealthy people are more likely to buy life insurance than healthy people. Unhealthy people are more likely to buy health insurance than healthy people. Healthy people are more likely to buy immediate annuities than unhealthy people. All right. The insurance industry knows that. And so they cover it in a couple of ways. One is by the application. They want to know what your family history is. Do you smoke? You know, a medical exam, those type of things. So that's one of the ways they protect themselves from adverse selection. The other way they do it is how they price the policies. For annuities, there's no underwriting on immediate annuities. They don't go out and assess your health. They just assume if you buy an annuity that you're above average health, and so they're going to charge you more for the product. So that really means if unhealthy people buy an immediate annuity, they're going to be overpaying for it because they're assuming everybody's healthy that buys this product, and so they're overpaying. So some products, all they do is they just charge more. They just assume the fact that you're buying this product means you're in the category that does better with this product, so we're going to charge you more. Moral hazard is really almost entirely the property and casualty side. Moral hazard is buying the insurance makes you more risky. So auto insurance, some of y'all have heard this example before. It's the most classic example. So you buy a Ferrari, you go to pick it up, $300,000 car or whatever. You get to the dealer, you go, oh, I forgot to call my insurance company. How do you drive home that night? Pretty slowly, right? You see another car coming, what do? You park and you wait for them to pass. It takes you 3 hours to get home. You only live 10 miles away. You get in the garage, you sleep in the garage, in the car, the whole night with a gun. Next morning, you call State Farm, they insure the car. Are you going to be a little more risky now? Yeah, because if anything happens now. So buying insurance makes you a riskier driver. Insurance companies know that, so what do? They charge you more. I mean, it's kind of sounds circular. If you don't buy the insurance, it's cheaper because you must be a really good driver because you don't have insurance. But if you buy the insurance, you become riskier, so we're going to have to charge you more because you buy the insurance. So it seems circular, but it's the way insurance companies think. It's a little harder on life insurance to think that people who buy life insurance are more likely, going to be careless. They're going to do more bungee jumping or whatever. That's because you have a whole lot more skin in the game with life insurance than you do with auto insurance. So it's not as likely to be true. Health insurance, I don't think so either. Do you know anyone that said, I was gonna go skydiving this weekend, but I don't have an health insurance policy? Possibly. That seems a little bit of a stretch. Mainly because, if you have an accident with skydiving, it's probably not gonna be one you're gonna live through. It's not gonna be too favorable. So I don't know. Or someone says, I was going to start smoking, but I don't have health insurance yet. Let me get the health insurance policy and I'll start smoking. It seems like a bizarre way to think. So it definitely works with auto insurance. And auto insurance is almost the only one it makes sense for, because even homeowners insurance, it's hard to think of that way. So you notice there's an E here. If you take the E out, moral hazard, that's when you buy insurance so that you can set your house on fire to get the insurance. That's illegal. You can't do that. With life insurance, that's not illegal. Buying life insurance to take one's own life to get the insurance is not illegal. It's just the insurance company does not have to pay you if you do it within a certain amount of time. Right? So they don't consider that insurance fraud, but they do have the right not to have to pay you out. Now, using moral hazard is you buy the insurance in order to defraud the company. There's other ways you can defraud companies without you being the buyer, where you set up accidents. I don't know if y'all have seen, these people that try to create accidents so they can get the insurance. That's moral hazard, but it's a little different here. We're talking about you actually buying the insurance in order to burn your house down. All right, so important concepts, important to life insurance with the possible exception of the moral hazard. All right, so type of insurance, life insurance. We're going to say there's two types, term and perm. Term insurance, perm insurance. Term is permanent. Term is temporary. So term insurance covers you for some specific period of time and then it stops. And the key here is there is no savings element. All you have is the insurance. So if you stop paying your premiums, you have nothing. It just expires and you have no insurance. Permanent or cash value has a savings element, which means if you stop paying the premium, you'll probably get something back. It's called cash value. That's your investment that you have. So some cash value that you get back. We'll talk about, I forgot the term, but what you really should do, especially older people, to have a policy that, you know, anybody over 60, you don't just cancel the policy. So there's something called a viatical company we'll talk about later. There's a way, even if your cash value is only 10,000, there's a way you might be able to get $40,000, $50,000 out of the policy by selling it to somebody else, and we'll talk about that. So term is really just one type of insurance. The key is the length of the term. So you got different terms. Permanent has all kinds of bells and whistles, and we'll have to get through those. Some people call this bundled. What the bundle means is you really have two types of products. You have a life insurance product and you have an investment product, and they're just combined together. Everybody have the notes, right? From this Canvas. So let's talk term. Okay, I'll get through there. All right. So one thing to think about with all these products is how premiums are paid. So for life insurance, you could have a policy that it's only 1 year and they change the premium every year based on your age. It can be guaranteed renewal. What guaranteed renewal means is they have to keep selling it to you as long as you keep the policy premium going. They can't charge you because you become unhealthy, but they can charge you because you're aging. So essentially, as you go from 30 to 35 to 40 to 45, if you get really sick at 45, you can still buy the policy and they have to sell it to you, but they get to charge you more because you're 45 instead of 40, but only in terms of everybody else. So the rate increases only with age, not with health. That's the guaranteed renewal. You can keep buying it. Another one is you pay the premium for several years and it's a fixed premium for several years. We're going to call that level term. One of my favorite products. You can just pay the premium until you die. That's got the word ordinary. Whenever you see the word ordinary whole life, you're going to pay the premium until you die. If you die at 99, you pay the premium at 98. So that's ordinary whole life. And then you can have a premium where you pay it and the insurance covers you your whole life, but the premium stops maybe at age 65. All right. So I built this chart. It's a little hard to see here because it's so skewed, but I used the mortality table to build this with those 4 examples. So let me show you to you where it's not quite so skewed. So this is the entire thing. This blue line is the annual term. It just goes up and up and up as you age. The orange and the gray are number 3 and number 4. The gray is you pay the same premium your whole life. The orange is you pay the same premium, but only to age 60. Oh, I'm sorry, that's not orange. That's, boy, what is that? That's yellow, excuse me. The yellow, the orange is the limit, the level term. Let me show you to you in a little bit more blown up a little bit. So the annual renewal term, it's the cheapest when you start because you're real young. But as you age, especially when you hit around 40 or 50, that premium starts shooting up. Level term is about the same premium, but it's fixed. So you can see for the first few years, it's more expensive than annual term. For the last few years, it's cheaper than annual term. All right, y'all see how that works? So in the first few years, because your probability of dying is so low, it almost doesn't matter. It's the same premium throughout. But as you get older, the level term, you pay more for 5 years, but then it's much cheaper the next few years. Here's the ordinary whole life. You pay it for your entire life. Here's the limit pay. since you don't pay your whole life, you're gonna have to pay more early, but then it just stops at some point. All right, do these charts make sense here? See how that works? I use actual real life mortality table numbers just to make it as realistic as possible. How does this chart make more sense? It's a little harder to read. As you can see, and I forget how much insurance this is, it must be 30,000. You can see when you get to end of life, the annual return makes no sense. Especially at age 99, you have a $30,000 policy at age 99, they're going to charge you essentially $30,000 because everybody's going to die. So, you know, at that point, it makes no sense to buy the insurance. You'll see on exam 2, I am going to be having some products that make no sense because ordinary whole life, you have to go to the end of mortality table. If I gave you a 30-year-old, it would take you several weeks to finish the problem. So I will have you have to do a 97-year-old because you can't have 60 years to have to do the numbers for. So I will give you some bizarre products, but they don't make any sense in real life. So what's the best? I mean, it's my favorite is level term. But level term at some point gets too expensive. So the idea with a level term is you buy insurance when you need it, when you're young and you have dependents, you have human capital, and then you just don't buy it out here, right? You just don't even do these. These don't make any sense. But I'm also a big fan of whole life. My mom bought a universal life policy, and boy, I wish she had bought a whole life policy. And I'll talk about why universal life was such a horrible product. Whole life would have been perfect. So there are times whole life can make a lot of sense, and that's probably what they should have purchased. But we'll talk about it. I'm going to show you why. All right, so no questions on that. Maybe when we're doing the pricing in the second part of the class, maybe I'll show you how to build this schedule. So it might show you how to actually do it, because it's, in fact, you probably can figure it out yourself. Get there. All right, tax treatment. Here's a huge advantage of life insurance. They get some tax advantages no other industry has. So death benefits are tax-free. They're not income. That's even if you paid $50 premium and you die, you get a $500,000 policy. That's entirely tax-free to your heirs. With one exception, you have to be careful. If you're taking a tax deduction for the insurance premiums, it's possible the life insurance can be taxable. But most people don't do that. The other benefit is on the cash value products. There's no tax while you're building up. So it's possible with the cash value products, if you get out of them early, there will be a tax, but there's not a tax until you get out of them. So even for products where you don't die and you get your money back, it's still taxable, but it's tax deferred. So you get that benefit. Because of that, there are some insurance companies that figured some really creative ways to create something that looks like a life insurance product, but really isn't. But because of the way it's designed, it gives you this massive, massive tax benefit. And so what insurance companies came up with was these endowments. We're going to talk about endowments. I love endowments too. In fact, the product I just showed you on that longevity product is essentially an endowment. But they were doing these endowments that said, okay, this endowment is for 10 years. If you die in the next 10 years, you get $500,000. If you don't die in the next 10 years, you get $500,000. So if you die in the next 10 years, you get $500,000. But anyone alive in 10 years gets $500,000. So essentially what they're doing, taking your money, investing it tax deferred, and you get it back tax-free whether you live or die. And the IRS said, no, 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 no. You're not getting away with that. And so they said, that's taxable. So essentially what's taxable, not the entire $500,000. The life insurance part is tax-free. If you die and get it, that's tax-free. But if you make it to the end and get the money back, you're going to pay tax on the investment gain on that product. Because the IRS is like, you're obviously just doing this for the tax advantage. That doesn't mean those are horrible products. You still get the tax deferral. They're just not as sweet of a deal. So companies were setting these things up essentially just give people all this tax-free investment income. And it makes a lot of sense until the IRS figured it out. These are called MEC and non-MEC. So MEC are the policies. You just mature endowment contracts. You can't do those. But life insurance, that is a huge, huge benefit. That tax-free nature is really, really quite powerful. That's why a lot of people use life insurance for estate planning. You got to set it up just right. The IRS doesn't like people buying life insurance the day before they die just so they can get this tax-free thing. You know, you go out and buy a $10 million life insurance policy with your entire wealth, and you die, your estate gets $10 million tax-free. You can't do that. So there are limits, but you can use life insurance to help manage your final estate in a very tax-efficient way. All right, let's talk about term. So term expires at some point. So let's see if this class can do better than my last class. So what's the shortest term you can think of? If you're going to buy life insurance for a term, what's the shortest term policy you can think of? An hour? Okay, that's pretty close. I could get a little shorter than an hour, but probably hour is pretty close, maybe 30 minutes. So what insurance would cover you for 30 minutes or an hour? Huh?
Insurance for surgery?
Well, maybe surgery. I don't know if there's specifically, I've never heard of life insurance just for surgery. Have you seen that before?
No, but like.
But you're real close, but I mean, that, I don't know if that exists, but that's actually a good idea. You should maybe patent that idea. It might be kind of expensive. It's a dangerous surgery, but that could work. But you're on the right idea. Yeah, flight insurance. I haven't seen it in the airport, but there used to be, I don't know if y'all have ever seen this. There used to be like a little kiosk. You could buy insurance for your flight. So if you fly from here to Austin, I don't know if we have a flight for here to Dallas, not maybe 30 minutes. Now it may end up in an hour. I don't know when it covers you. If you're sitting on a tarmac, maybe it doesn't cover you. I don't know. You have to read the fine print. So it can be very, very short period for something that's just very specific. And supposedly it can be 30 years. There has been 30-year level term. The insurance industry doesn't really sell 30-year anymore because of some new regs, but it can be up to 30 years. But 20 years is pretty common. 10 years is probably the most common. And in annual term, you can certainly do that. So renewable term, we just talked about that. You have the guaranteed right to renew the policy. So you're always, doesn't matter how unhealthy you are, you can always renew the policy, but it's going to go up with your age every single year. Now, flight insurance, they may not even ask your age for flight insurance. They almost don't care, right? So flight insurance is kind of a unique one. They might ask the age of the pilot, but they're not going to ask your age. But renewable term, your age is huge part of that. Level term, my favorite of all, is you get a fixed premium for a set number of years, probably 10 years. And then when that expires, you get a new policy. But it shouldn't expire. So this is the key. If you ever buy level, most of you are going to buy level insurance because it's the best kind. But be careful. Don't buy 10-year level policy and think you're going to renew it at the end of 10 years. That's not what you do. You start shopping around year 6 or 7. What happens a lot, life insurance mortality tables have been getting more and more favorable. So you might find that you bought a policy that's $40 a month, and 7 years from now, you could buy another 10-year policy that's only $35 a month. And that would be smart to do, right? Because you get an extra 7 years and the premium's lower. So level term, you start reshopping it. You don't wait to the very end, because if you get really sick right at the end of the 10 years, the policy runs out before you die, and then you can't buy a new policy because you're sick. So you want to somewhat start thinking about it around year 6 or 7, start pricing it and see. And if you can get the same or lower premium, but get it for 10 years, you always switch. Remember, there's no cash value, there's no tax consequences of this. You just switch policies. And they're very easy policies to price, very easy to compare one policy versus another, right? It's just a premium. So very simple product, makes a lot of sense for young people because it's very, very cheap. And it's a fixed premium. You don't have to worry about it, the premium going up every year here. You know exactly what you're going to pay for 10 years. And then 6, 7 years later, if you're really still healthy, you go out and see if you can get a cheaper product somewhere else. Convertible term, we're not going to spend much time at all on, but the policies you get from your employer are term policies. And sometimes when you quit your job, they may allow you to convert that to a permanent policy. You're highly unlikely to do it because usually only really sick people do it. And so it's probably not going to be a very valuable product to you. There's a lot of anti-selection with those type of policies. And most people don't buy convertible term. It's usually part of your employer contract. Industrial life, we won't spend too much time on this one. I'm not even sure it really even exists all that much anymore. But industrial life was essentially funeral insurance for poorer people, poorer households. They're sold door to door, so they're very expensive products to sell because the sales force is very expensive. They look cheap because they don't cover much. So you might say, well, it's only $10 a month, but it's $10 a month for very little coverage. So most people in this case would be better off just buying a term policy. That $10 might get them $50,000 of insurance versus the $10 here only is going to give them, a funeral, $10,000 funeral. So it's a low premium relative to, because it's just so little coverage, but it's expensive relative to the amount of coverage you're getting. So you're better off just buying the term unless you're worried. The nice thing about this is you can force it to pay for your funeral costs. But it really is just funeral cost coverage. There's no human capital. They're not worried about your income. All they're worried is making sure you get buried. What do we do to people who die without any relatives, any money? There's a documentary. I have it for this class, but it's so morbid. But it's about what do you do to people who have no kin and they die, and they cremate them and they dump them all in one grave. And on the documentary, they show them dumping the ashes, and the ashes is just blowing. There's cars driving by through these ashes of these people's bodies because there's windy. It's like you think they could show a little bit more concern for these people's lives, but yeah, it's pretty sad. It's an interesting movie because you have to do something with these people's bodies, and someone has to pay for it, and they don't put much expenditure into it. So there are really poor people that just the end of life, it's taking care of that body is just an expensive thing to do. Cremation is not free either. It's a lot cheaper than a casket, but it's not free either. So this is the type of insurance at least gets you something decent there at the end. All right, here we come to one of my many least favorite products for credit life insurance. And this you're forced to buy, which I'm discovering that the mortgage business forces us to do a lot of things that make no sense, like title insurance and credit life. But essentially what they're saying, hey, if you die, this insurance will pay your mortgage, pay your auto loan. It's terribly expensive insurance. You're much better off just buying a term policy. You'll get a much better policy for a lower premium. And the really bad thing about this is you're not the beneficiary. The only one that wins on this is the bank. You don't win. You'd much rather, if you have a $300,000 mortgage, you'd much rather your family get $300,000 and they decide whether to pay off that mortgage or not. I mean, just think about it. You got a $300,000 mortgage. You refinance it in 2020, so your rate's 2.8%. Do you want your family paying off that mortgage? No, keep paying the 2.8%, put the $300,000 in a 5% CD. I mean, it doesn't make sense to force them not to pay off this debt. So term insurance gives the family the right to decide. Now, obviously, your mortgage company is not going to let you take a mortgage unless they make sure you got this coverage. So you may not have any choice, but it's not good insurance. You don't need it for your car. I was on the board of a credit union, and they started selling this. It's like, why are we selling this? It's really awful insurance. And they said, well, we have customers that are demanding it. If we don't give it to them, they're going to go borrow from somebody else. So they're telling us they have to have it. We can provide it. And it's like, yeah, but it's horrible insurance. They think it's really cheap, but you're talking about a $20,000 car for 7 years, and the balance is going to decline, right? Your insurance declines as you pay off the debt. That's not much life insurance. It's very low. So the premium sounds low because you're not covering very much. And so it's just horrible insurance. But we sold, man, it's like, I can't believe anybody's buying this. And this is a credit union for an insurance company that has products that are much cheaper than what we're selling. And those employees could just go buy from the life insurance company. Instead, they buy it from the credit union. It made no sense to me. It's usually sold on group basis. So your credit union is essentially got a group policy, and they're bringing in new participants as they sell. So they're not selling individual products. It's under a group. We'll talk about group insurance later. So yeah, again, you're better off just buying the term insurance. It's going to be cheaper, and you have the choice what you do with the money. You don't have to pay off the loan. So again, the primary beneficiary is the lender, not the beneficiaries. All right, so there's term. So what are y'all going to buy? Well, a lot of you, you're going to get free insurance from your employer. At USAA is one-time salary. You can do more than that, but you have to pay an extra premium. So take that. That might not be sufficient, right? Because that's only 1 year of your salary to cover until the end. I would say your second stop is level term. Then you got to decide between 20-year and 10-year level term. 20 years is a lot better if the premium's not massively different. It's going to be somewhat different. I may have to get on the USA site and price some of these, because the wonderful thing, USA site has a lot of calculators where you can actually figure out what these premium, and I can change the age. It doesn't have to be my age. I can change the age and gender. I've done that in pricing annuities for my mom. I can put her age in there, and so yeah, they're really great calculators. So, you know, look at it. For me, 10 versus 20 years would be radically different, right? For someone who's 60 years old, 10-year versus 20 years can be a radically different premium. But for a 20-year-old, not many people die between ages 20 and 40. So there might not be massive. We can try it and we'll see, but not all that massive. So level term, I would look at 10 versus 20. You're probably not going to get the option for a 30. And most people don't like 30 anyways. So that's probably your most likely one. You're probably not going to do renewable term. Doesn't make a lot of sense. When do you buy this? So if you have no dependents, the issue becomes, I mean, it's a little bit of a risk. So you have no dependents, but you're really healthy, but you think you're likely to get married and have kids in the next 5 years. You kind of thinks, you know, I might get engaged, get married, and suddenly I get diagnosed with some disease. Should I buy it now just in case? I wouldn't, but I mean, it's kind of thing to think about. I would buy the level term when you get engaged. Don't wait until you get married. When you get engaged, I'd buy it right at that point, because you know you have this coming. And then you and your spouse have got to figure out how much to buy. We have calculators that do that, right? You can load those calculators to figure out how much insurance you need and how much you can afford. The nice thing about level term is it's going to be the cheapest. Over that 10-year period, it's going to be the cheapest. So if you can't afford it with level term, you're not going to be able to afford it any other anyways. So that's the one I would look at. Where would I go? So what are y'all? I'm curious what y'all think. It's probably pretty obvious on auto insurance. Geico, Progressive, State Farm, Allstate, Farmers, USAA. Can y'all think of others? I mean, that's a pretty good list. They're pretty competitive. If you can get the cheap, and you go to the cheapest rate, pretty straightforward, right? I mean, do you buy your auto insurance from the company that's going to give you the best service? Do you really care? Have an accident every 20 years. I don't care if their service is horrible. I just need to pay my car to get fixed. So premium's all you care about. What about life insurance? What's on your list to shop? And let me warn you, you shop life insurance. Life insurance is far less competitive than auto insurance. So shopping 5 companies, you could get 5 very radically different rates. Allstate, Geico, Progressive, they kind of know what each other's doing, and it's probably gonna be fairly close. But life insurance, so give me a list of companies. Who would you say?
Aflac.
Oh, Aflac. Do they sell life insurance? Oh yeah. Did they have good rates? They interested. I think
I mean, compare the policy I bought back 31.
yeah, I don't usually think of them, but they certainly could. They are an insurance company. Who else would you put on your list? Geico, not life insurance. No, I don't think Berkshire Hathaway has any. They have life reinsurance, but I don't think they do any direct life. Huh? Northwestern? Even though the lady from there says my students say I hate her, I do think it's a very high quality company. And it is a mutual, which I do like that. I don't know, is Aflac a mutual or a stock? They must be stock, right? They're publicly traded, aren't they?
So, Liberty.
Liberty. I don't know about on the life side. I'm not as familiar with them. They're more known on the auto side. State Farm does have a life insurance company, and it's competitive. well, I'll talk about them later because my brother had a policy from them, actually a level term policy. Yeah, USAA, the company doesn't charge commissions. I think that's always a good place to go. One thing I like about USAA, all the years I was there, their goal on every product is to be in the top 25% on premium. So it gives you a good base that you know they're not ripping you off. It may not be the best. If you can get cheaper, you go cheaper, but at least you get a nice benchmark that they're trying to be in the top 25%. So you haven't mentioned Danya's company yet, but interesting. Met is definitely, I think they're the largest too. MetLife has some good commercials. I mean, some good products. I don't know if they still have Snoopy or not. But good commercial, and they got the MetLife building in New York City. I don't know if y'all seen that thing.
My favorite, New York Life.
New York Life. You know, let me tell you on New York Life, I don't know anything about their products, but I met their investment team and I remember thinking, wow, I wish I could work with this company. That was the sharpest group of people. But that's the investment side, not the product side. They're probably heavy commissioned as well. Others? I don't know if Humana sells life insurance. Do you know if they do? They might. I don't know. So none of y'all mentioned Prudential. Why didn't y'all mention Prudential? They're pretty big. So get a piece of the rock. Y'all remember that? I don't have a TV, so I don't know whose commercials is whose. So Prudential, that's a good list. Most of them probably have an online calculator. Now the problem with USAA is you can only use their calculator if you're a member, so you have to have an account. But most of these companies, you can shop these online. And the nice thing about level term, now they're gonna have to ask you some questions. My advantage at USA, they know who I am, so they have a lot of my information already. So you might experiment with a few of these, but I would say always at least 5 companies. And I threw USAE in there because I know their goal is to be competitive on every product. So if you have 5 and one of them is USAA, then you know you've got at least one that's competitive. And then if someone beats them, you know you got a really good deal. So, oh, we got to stop. All right, we'll stop there. I got to run to my next class because we're having guest speakers. All right, let's start. One kind of admin thing. I just realized our exams scheduled for 10/5, but that's the day USA is coming in and we have the ICT speaking to us. So what I want to do is I'll split the difference. I'll email this out, but we'll do the math problems on the 3rd. So I think that takes like 30 minutes. So it'll be out early. We won't do any class after that. And then usually I make the essays due 6 o'clock, but I'll give you to 2 o'clock on Friday. So that you're not worrying about the essays during the USA. Does that make sense? Everybody work with that? So the math problems a couple of days earlier, but the exam, you get an extra 20 hours or so. All right. And the essays, you've already gotten one of them. It's the ethics essay. So you already have that one. The second one we might get to tonight, which is perm versus term and understanding the math behind those. And then the math problem we'll get to here pretty quickly. When we start annuities, I might skip annuities and go right to the math problem and then come back because it's an annuity math problem. And then you'll have everything for the exam ready to go. And then you have a few weeks to get ready. So questions on that? So you'll know exactly what's on the exam, and the essay questions are you submit them in a Word document on Canvas. So they're essentially open book, but as I tell my investment class, don't copy and paste from the notes. I don't want to read my own words. So read the notes, listen to the lecture, take notes, and then write the exam. You know, maybe there's 5 parts to the essay. Write each part from the top of your head without looking at any notes. Don't do any copying and pasting. So maybe you don't want to write the entire answer or throughput, but do sections in your own words without looking at notes. So read, think about it, so that it's entirely in your own words. You'll see, well, you've already gotten the ethics questions, which is kind of an involved one. I'll put it in the weekly email. Are y'all getting my weekly email, everybody? So whatever y'all put in the Canvas, this should be what you're getting. Okay. So we're talking about these products. We talked about the term products last time. Now we get into what's called whole life or permanent. I'm going to somewhat question if these are really permanent. You'll see when we get in some of these crazier products. So ordinary whole life is what most people thought of insurance back in the 50s, 60s, and 70s. You go on the insurance company and say, I want insurance. And they say, okay, that's going to be $80 a month for $100,000. And you pay $80 a month until you die. And that's it. It's very straightforward. You can even tell in the title, it's whole life. What does word ordinary mean? It means you just keep paying until you die. Ordinary whole life. I don't know what the breakdown was. I don't know when level term came around either, but for most insurance companies, their majority is term. And then back in the 60s and 70s, maybe it was 40% whole life and 60% term, something like that. The USAA was more skewed. It was like 80% term, 20% whole life are these permanent products, because USAA is a direct marketer. It's a little harder to sell whole life when you're a direct marketer. You don't have seasoned agents. But whole life, I think it's a great product. It makes perfect sense. One thing is really, really critical of this is you know your premium forever. You're going to see that's really, really important when we talk about these other products. So your premiums, it's a fixed premium, never changes for your entire rest of your life. The worst you can do is pay that premium. It is possible you might get a dividend back that reduces your costs. So you may actually do better, but you can't do any worse. That's exactly what you're going to pay. What if 10 years later they discover, wow, people are dying faster than we thought? Well, that's the insurance company's problem. You keep paying the premium and you're covered. They can't come back and say, whoops, we messed up. We fired all our actuaries. We got new ones in. No, that's their loss. It was amazing to me, the life actuaries where I worked, they didn't just keep track of this product. They kept track of this product by year. So they knew the profitability of the product they sold in 2003 and 2004. They kept track of each product because mortality rates do change. But I mean, that's pretty incredible, right? They know exactly how they're doing with every single product that each year they issued it. So ordinary whole life, limited pay whole life is essentially the exact same product, except they say once you hit some age, you stop paying the premium, usually maybe 65 when you retire. So the premium is going to be higher, but then at least you know once you hit retirement, you don't have income anymore. You don't have to pay the premium anymore. Remember, on these permanent products, they have what's called a cash value, which means that's your value if you cancel the product. You decide not to pay the premium anymore, that's the money you get back. Generally, the tax consequence, I'm not a tax person. The tax consequences of that cash value kind of depends on the type of product. You would think it wouldn't be worth much because you've probably paid more in premiums than you're getting back. But there is the savings element. There are taxable gains possible. But for the most part, you'll get some money back. And we'll talk about when we talk about biodicals that may not be your best option. You might actually sell the policy to another company rather than just taking that money. I mean, if from your standpoint, you just want the most money you can get. You don't really care how you get it. So, all right. So now we get into the late 1970s when interest rates were so high and insurance companies are losing all this money to banks. Bank CDs are paying 15, 16, 17%. And life insurance companies have these whole life policies that are paying like 3%. People are like, why am I making 3 when I can make 15? So they're taking their cash value. They actually weren't even surrendering the policy. They took cash value. You can borrow your cash value. So they're borrowing their cash value like 3% and sticking it in a CD at 15%. If they die, their estate gets their life insurance minus the loan, but then they also get the CD that was making 15%. So they come out ahead. There's some tax consequences, obviously, but they come out ahead. And a lot of people are doing that. So there is this cash drain coming out. So universal life didn't really fix that problem. Didn't say, hey, we got a product that's going to fix all. They're still losing money for whole life. What universal life allowed them to do was start all over with higher interest rates, get them into the current market. So essentially what they're trying to do is all the money leaving here, they wanted it, instead of going to banks, they wanted to come here. So say, stay in the company, we've got to use universal life policy. Yeah, your whole life's only paying 3, but our universal life's paying 9. And so they can move it over. So introduced in 1979, and wow, it took off. So we already talked about disintermediation before. That's a move from one intermediator to another, from life insurance companies to banks. And so this is what people are doing. They had a cash value on their whole life. They would borrow that at 3%. The bank pays 18%. And life insurers were seeing cash leaving them. All right, so talk about that. So the premiums, the cash values, the level of protection can adjust up or down in different ways. These products have a lot more bells and whistles. None of the bells and whistles make it a better product. It just makes it more complicated. If you get more stuff, you pay more. If you get less stuff, you pay less. And it's pretty tough for a retail person that's buying insurance to be able to figure out the difference between these different products. So it just creates uncertainty. But the big deal here, when you see the word universal, always associate the word universal life with the word unbundled. What unbundled means is the insurance company, with the whole life, you get one premium, $80. Some of that premium is buying the insurance, some of it's setting up the cash value. With universal life, you have 2 premiums. One of it's the insurance, the other is the savings element. You have to pay the insurance, but you don't have to pay for the cash savings. So they're essentially unbundling it. So whole life was bundled, you got to pay one premium, you don't have any choice. You always have to buy the cash value, the savings element. So essentially, the insurance company is giving their I guess investors, their insureds, a choice, but they have to do the COI, the cost of insurance, that must be paid. If you don't pay the cost of insurance, the insurance cancels. So you always have to pay that. There are different ways to structure it. If anything that gives you a better benefit, it's going to be more expensive. So between A and B, it's just what premium do you want to pay? So some people want the cash value plus the death benefit. Most people just want the death benefit. So if the face of the policy is $200,000 and your cash value is $60,000 and you die, you get $200,000. Essentially, the insurance company covered you for 140 and you've covered yourself for the 60. If instead you want the 260, you want the 200,000 plus your cash value, then at least you're getting some of your money back. But it's going to cost you so much more. It's it's kind of flip a coin. But it's more complexity, right? You see, we're already getting more complexity. We got it's an unbundled thing. What do most people do? Most people are set up on automatic withdrawal, so they're just paying the full premium every month anyway. And they have some choices up front, but once they make that choice, on the loans, they can borrow their own cash value, but insurance companies started doing market rates on the loans. Unlike the whole life where you had a fixed rate in the policy, universal life is not going to have a floating loan rate that's going to go up and down with interest rates. And usually it's going to be higher than the crediting rate. Whole life was kind of cool where they pay you 3%, and if you borrowed your money, it costs you 3%. Now with universal life, they may be paying you 8%, but if you take your money out, you got to pay 10. So you're actually penalized for taking your own money out. All right, so this is what changed. See if I can do this. So all whole life, there's almost no marketing. You just had a premium or whatever, $150. Pretty easy. You have 10 companies. You're buying a $500,000 policy. Take the one with the cheapest premium. Very, very simple. In universal life, suddenly, if I can do this. There's all this marketing, all this legal stuff at the bottom. This is what the advertisement started looking like. Now, we went a little much there, but But the advertising, suddenly, if you got the little pamphlet in the mail, guess what was the biggest number on there? The crediting rate. What does this look like? The insurance company is no longer an insurance company. What does it look like now? Looks like an investment firm. What are the advertising? Not insurance, advertising the crediting rate. It's like the insurance doesn't even exist. So you started noticing these pamphlets, and I noticed it because right when I started USA a few years after they started Universal Life, and I saw those little glossies. And yet, whole life, you don't put the interest rate in there. It's in the contract. It's kind of low key. Universal Life, the interest rate was central to everything. So let's talk about this a little bit more then. They got these two companies. The salespeople come to your house. Company A comes in and say, hey, our Universal Life is paying 7.2%. The other company comes in and say, hey, forget them, we're paying 7.8%. So which product are you going to buy? Sounds obvious. Now what do? Company A pays 7.2%. Their cost of insurance is $250. Company B pays 7.8%, but their cost of insurance is $380. Can you even figure out which is the better product? You'd have to run quite a few scenarios. It would depend on when you die, right? If you die really fast, you don't really care because you're not going to get much from either one. I mean, you get the face. So which do you buy? You'd probably have to do a stochastic model running 1,000 scenarios, because sometimes A is going to probably win, sometimes B. It depends. But the other thing you have to watch out for is, oh, we already got the word, bait and switch. So what is bait and switch? Have I heard that term before? So company B sells a lot of Universal Life in April. Guess what month of the year there is their highest crediting rate? It's in April. So they're selling it to you. When can they change this rate? Tomorrow, right? They can change that rate anytime they want to. Do you think insurance companies prop up the rates when people are buying and lowball them when they're not? Yeah, absolutely. Happens all the time. TSAs that are sold to teachers, guess when that rate's really high? In August. Why? Because teachers come back, they got to make decisions. Oh, that one has the highest rate. And a lot of firms, August is the highest, and in September it drops dramatically. And you think teachers would figure that out, but they don't have time. They got to do a bunch of stuff, so they're not worried about it. You see the complexity now. Did you have this complexity with whole life? What did you have with whole life? You had a premium. That was it. Here now you got this rate, you got this premium, and you got the fact that it can switch at any time. Yeah, that's what I mean by complexity. What percentage of Americans can pick between those two products with any confidence? Could Albert Einstein figure this out? This would be a tough problem for Albert Einstein, wouldn't it? He'd have to get a mortality table. He had to look at interest rates. He had to figure out this company's history on paying rates, right? Because they can pay whatever they want to. He'd have to get all that history. Where would he find that? He didn't have the internet back then, so it would have been really tough. I think it's practically an impossible problem. I'm going to show you how you can pick a company based on their historical performance and then hope that that applies in the future, but it's hard to get that information. So bait and switch is pretty popular, pretty common. So Universal Life is sold on accrediting rates. So the cost of insurance kind of gets lost, but the cost of insurance can be radically different between different companies. So complication. We already talked about that. And the other thing we have here is the vanishing premium. Have you ever heard that term before? You should type in class action suit vanishing premium and see how many life insurance companies come up. So the way these things were sold, they were sold when interest rates were pretty high. So let's say they started with a 9.2% rate. What the insurance company, they said, well, what if interest rates stay really, really high? You know what? The cash value on this policy is going to grow so large, the person after like 20 years, they can just stop paying the premium. Because they're going to have such a massive cash value, they can pay all the premiums out the cash value and they don't have to worry about the insurance. That's pretty cool, isn't it? It's like free insurance. And that's what they're telling people. You know, after 15, 20 years, the premium, you can probably just stop paying the premium. What does that depend on? What has to happen for that to happen? Interest rates have to stay high. What did interest rate do in the 80s and 90s? They fell dramatically. What happened to vanishing premiums? They didn't vanish. So guess what they did do? You've got the cost of insurance. What does the cost of insurance does? It rises with age. You got the cash value. It rises with the crediting rate. What did the crediting rate do in the 80s and 90s? Falling, 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 falling. What's the cost of insurance doing? Rising, 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 rising. Is it possible that the total premium is less? So let's say you have a $500 premium, $50 at the beginning was cost of insurance, the other $450 was going to your cash value, getting paid 9.2%. But that cost of insurance is going to grow. Is it possible that cost of insurance could be greater than the entire premium? And yes. But what's supposed to happen then? Then you draw from cash value. So it's okay. Yeah, okay. Now my cost of insurance is $800. My premium is $500, but I have so much cash value, I'm going to pay for it. What's the problem going to be? When can you not do that? You're probably thinking the obvious, but it can't be that obvious. So when can you not pay the cost of insurance from the cash value?
If there's no cash value.
Yeah, if cash value goes to zero. Why? Because interest rates fell. They weren't paying 9.2%. They're paying 4%. That's a big difference than what that salesperson said. The salesperson said, hey, interest rates be high forever and ever and ever. What do you think the salesperson should have said when they sold this product? Do you think they should have been required to have done a scenario with interest rates falling? I think they should have. So, oh, by the way, if interest rates fall, this could happen. So what could happen? I gave you Danya. Was it last class? Danya? When did I give you Danya? Let me give you my mom. All right. She bought one of these policies. My mom's very smart, but she was very confused about this policy. She didn't like the salesperson at all. She kind of like at the end was like, this person's trying to rip me off. She just didn't feel comfortable with this person. But she really didn't know she was buying life insurance. It was very, very confusing to her. But she bought a universal life policy. Her starting premium was, I think, $250, somewhere around in that area. I can't remember the exact premium. It was around $200 something. And then as she aged, or the insured aged, as the insured aged, the premiums started getting really, really large. And it started taking the cash value away. So when the cash value disappears, what does she have to pay? She has to pay the cost of insurance. Anybody want to guess? So when her cash value got down to like $1,000, $500, my mom's panicking because she's like, okay, they tell me the premium's going up and say how much. And so I should show you what the insurance company sent her. It was, or actually sent me. I asked for all these details, and what they sent me was just, I can't believe they would send something like that out to a retail person. Anybody guess what the premium went to? This is a monthly premium, $250 to, you know, it's crazy. So think crazy. You really pretty close. It went up to 1650. Is that a little bit surprising? You bought a policy. What did I say? This is permanent insurance. Does that sound like permanent insurance? If your premium can go from 250 to 1650 overnight. So now what do you have to do? So you got to look at the person who's insured and ask, when are they going to die? That's a pretty rough question to ask, right? And if the person's unhealthy or healthy, but even if they're healthy, they could still die the next day. If they're unhealthy, they can live. There's a lady I've been working with. Oh, I think it was 20 years ago. She had a policy. She wanted to cancel it. And right when she's about to cancel it, the person that was insured was diagnosed with cancer. So she said, well, I'll just keep it. And that was 20 years ago. He died last week. So 20 years, you know, it's tough to guess when people are going to die. So it was pretty tough. The person that was insured was not in really good health, but had horrible health previously and kept surviving. So this is a person who would get sick and then live and come over, you know. So what I did is I said, okay, Mom, I'll pay the premium. And when this person passes away, you'll reimburse me for those premiums. And then if they live to be 150, then I'll take that risk. Knowing that premium 1650 is going to do what? Once a year. Now it was fixed for a year. That's kind of the good news, right? Cost of insurance. But what's it going to do? We're talking about someone in their 80s. What's it going to, you know, cost of insurance is not going to jump, it's going to leap. So it's going to be 1800, 2000, 25. It's going to be shooting up really, really fast. The other thing was policy ends at age 95. So if this person makes it to 96, I've got nothing. Right? This is a person whose I went to his mother's funeral. He died at 96, and her two twin sisters, older twin sisters, were at her funeral, as was her younger. So she had 3 siblings in their 90s at her funeral. So there's some longevity in this person's life, right? But so these are horrible decisions to throw on people. You're sitting there trying to figure out when a loved one's going to die, and you got to make these incredible financial decisions. So it ended up, I mean, it's bad that the person died, but it ended up that the person lived about a year longer. So, you know, it came out from an insurance standpoint, okay, you know, you're making these decisions where you're, you know, it's just awful thing for an insurance company to do. What if she had a whole life policy? If she had a whole life policy, maybe the premium would have been, I don't know, 280, 290. But what would it have been at the end? It's still been 290. No decision, you know, would have been pretty simple. That's what they should have purchased. That would have been the simplest product for them to do. Why did they get sold to Universal Life? Any guesses on that? Why do you think the sales rep pushed Universal Life? The commission, right? Insurance companies make more money on Universal Life than they do on whole life. This was the commission. It was no question. The lady who sold it to my mom made a mistake of leaving her big packet of, I might have told you that before, leaving her big package of stuff. And there was some pretty insightful stuff in that package. I remember my mom afterwards, she goes, yeah, she left this thing at my house years ago. I don't know if this be useful. It's like, yeah, she shouldn't have left that. She left kind of inside information on the company. It was a hard sell based on what she was going to get out of it. So I hate that our industry does this to people. I think it's unconscionably horrible. And they don't think at the time of the sale, they just want the sell. They don't think about what's going to happen 5, 10, 15, 20 years from now. They just want to make the sell. And it puts people in really horrible situations. So I'm not a big fan of Universal Life. Now, right now, might not be so bad because we're kind of at lower interest rates. So, but I do think if you buy Universal Life or you have family members, ask them to run some scenarios. What if interest rates fall and stay low for quite some time? What would this look like? What would the cost of insurance be? How high could it get? Those kind of questions, because when you need this policy, you don't want to have to making those type of decisions. Or even better, just buy the whole life. Now, you could price the two of them and see, right, which one has the better premium. But do realize, you know, Universal Life, you have the advantage of interest rates rise, you'll do better because they'll be paying you more. Whole life that can change its rate, so your cash value can change a little bit better. You can't decide how much premium you make, but the cash value can change. So the rates are a little more current, but they're not as competitive as universal life. So you got to watch the cost of insurance. You've got to watch the crediting rate. You got to watch the loan rate. It's just a very, very, very complicated product. So when I hear permanent insurance, it's you're covered for your whole life, and you don't have to worry about your premium going up fivefold all in 1 month. That doesn't to me sound like whole life. Have I sold y'all on universal life? Everybody's going to run out and buy some. I'm not sure how well it's selling today with interest rates low, especially a couple of years ago. It tends to struggle, just like bank CDs struggle in these type of markets. But it was a huge, huge selling product in the 80s. This was USA's big thing when I started at USA. Universal Life was a huge, huge, huge product. It was so huge. I remember had it in my MBA. We had a case study on the American Can Company. And in the early 80s, they bought a universal life insurance company. And the other team, we're competing with the team, they thought it was a good idea because they're diversifying themselves. My team, which was me working in a life insurance company, and my other team member was the CFO of the life insurance company. And we're like, what does the CEO of an American can company know about universal life? This is a very complicated business. They're really getting out of their comfort zone. Why were they buying it? Because it's a really proper product at the time. We thought it was a big mistake. Why are they diversifying? Stick with what they know. Don't buy universal life policy. But that was how popular universal life was then. A tin can company was buying a universal life insurance company. Just didn't make much sense. Okay, questions on U-Life or universal life? So when you see the word universal, think unbundled. All right, whole life is bundled, universal life is unbundled. All right, now we're going to add a new word, the word variable. Anytime you see the word variable, think dual regulation. So universal life was introduced because of high interest rates and disintermediation of the banks. Variable is introduced because of a strong stock market. So what the life insurance industry said, you know what, the stock market's doing great. What if we let our customers decide where they put their cash value? We'll say, you know, instead of us paying your rate, we'll let you put it in the stock market. So that's essentially what they do. With the word variable, they have the choice of where they put their cash value. Now the insurance company gives them a list of mutual funds, and they essentially pick which fund they want to go into. But why do I say dual regulation? So there's a big, I think there's a Supreme Court case, a big court case. We'll talk later regulation. Insurance is essentially exempt from a lot of federal regulation, especially on antitrust. But that's for insurance. And the SEC came in and said, this doesn't look like an insurance anymore. This looks like an investment, and we regulate investments at the federal level. And insurance company says, no, you don't. We're exempt from federal regulation. So this went to court, and the insurance industry lost. And the court decided, yeah, there's insurance that the state regulates. There's also an investment the SEC regulates, so that you have dual regulation. So if you sell these products, I don't know, Dylan, if you saw that at your firm, do they do variable products?
Yeah.
So you have to have 2 licenses, right? You have to be able to sell the insurance and sell. So it's a little more expensive. You got to get a new group of sales reps, which is great for them. They make more money. So that dual regulation, but at least you participate in the stock market. Pretty popular product, but you notice there's no word universal there. So here you have some pretty good risk that, you know, if your stock market's not doing well, you could have a problem with this policy just collapsing because you can't really change the premium. And so they fix that by doing variable universal life. So I don't think variable life really sold all that much, but variable, so you can invest in the stock market if you want to. Universal, you have the choice of how much of the premium you pay. You have to pay the cost of insurance, but you don't have to pay the savings element. So variable universal life. Now, when I say you have to pay the cost of insurance, remember you can pay the cost of insurance from the cash value. You don't necessarily have to cut them a check. So you always have the right to pay the premium out of the cash value, But once the cash value goes to zero, you have to pay that cost of insurance, so the product goes under. Let's see what. We'll just see here. Variable universal life Orman. What do you think Susie Orman thinks about variable life, universal life? Sue Orman views on life insurance involved. She believes that permanent life insurance as a whole life or index universal life are bad investments. I don't know why she doesn't like whole life. So there, y'all recognize her? She used to be real popular. She's probably like 97 now. I don't know. I haven't really paid attention. Term versus whole. That's going to be your other essay question. Term versus whole life. How much insurance? So it'll be interesting to see what she says on these. But she doesn't like these products somewhat for the same reason I don't like them. They're complicated and they're expensive. And they're expensive because they're complicated. They're so complicated you don't realize how expensive they are. Remember, with life insurance, they're not doing anything fancy that the investment world's not do, that the investment world's doing. I mean, they're buying stocks, they're buying the exact same securities, but with much higher expenses. They have to charge much higher rates. What's the advantage that offsets that? You remember that? More expensive, but remember the offset? The big benefit, life insurance, is the tax side. Much more expensive product, but you get these wonderful tax advantages. I've seen some articles on variable universal life, assuming some decent stock market, how long you have to hold a product such that the tax benefits offset the higher fees. And it can be 20, 25 years. So it's a product you got to hold a really long time so that those tax benefits offset those horrible expense differences. So you're going to make a better return going to mutual fund, going to the investment firm, because you don't have all those extra fees, but that mutual fund is probably going to be taxable. If you can invest in mutual fund and a Roth IRA, you're probably better off with Roth IRA because you get the tax benefits and you don't have to worry about all those expenses. How do you spell Ramsey? Dave Ramsey. What do you think he thinks on it? Is that Dave Ramsey there? Ramsey Solutions? My guess is he doesn't like them. I'll listen to his program. He has some really wild views. I've always believed that thieves follow his class members home because they know they all have cash. They have envelopes of cash sitting at home because that's what he recommends. It seems kind of strange to me. I would say put it in the bank. So he has a few strange views. I have a little bit of questioning on him on the investment side. He and Susie Orman have gotten some bad press about their relationship with this industry and what kind of incentives they have for pushing certain mutual. I don't think Dave Ramsey has any investment skills to be recommending things. He does well with budgeting, which is fine. He has some interesting ideas. My guess is he hates universal life and variable universal life for the same reasons I do. That tends to be pretty common. If you really think the stock market's going to do well, yeah, I mean, it's an interesting product because of its tax advantages. So it's the life insurance, when you die, that comes back tax-free. If you take out the cash value, it's possible that's going to be taxable. So the main benefit is going to be is it might reduce your premium over time because the stock market's doing so well. It's an interesting product. I would never buy one. Now, USAA sold variable universal life because it took off. And it was what they discovered is you can't sell variable universal life if you don't have sales agents. It's hard to sell this product over the phone. Why? Because it's so complicated. So they had sales agents. So they had to shut it down. My recommendation, if USAA sells a product like this, you should buy it. Because what happens is they sell it, it doesn't work out, and so they have to bribe their customers to let them shut it down. So they ended up giving them these really sweet deals to shut the product down. So the people who bought it actually did pretty well because they're like, hey, we just want to get rid of this thing. What do you want for us to shut this down? So, next time they do that. All right. Questions on variable products. So Thanksgiving is when you go home and you ask your parents and aunts and uncles and figure out which of them have these products. Now, the question is, do you want to depress them on Thanksgiving or just keep your mouth shut? That's kind of thing you can think about. But it's like, why did you buy that? You could really scare them. But anyway. All right. Endowment life insurance. We somewhat talked about this. It's a product that pays you whether you live or die. So an endowment that's why, remember the tax, they don't like matured endowment contracts. So it's a product that if you die, it's just like life insurance. And then at some point you make it to the end, it still pays you at the end. So you get your money either way. It's very, very tax efficient until they change the tax code. But I still think it's a pretty decent product. So even with the tax code change, there is taxable money, but it's still deferred for many years. So you do get the tax deferral. If you die and get the money, that's tax free. It's only at the end if you live and you take it at the end, that's taxable, but it's not like the whole thing's taxable. It's taxable just on the gain, and there's no penalty. It's just that you get taxed on the gain just like you would have, except for at least you delayed it for 10 or 20 years. The product I showed you with the Carroll file was an endowment life insurance, but it only paid you if you lived. It didn't pay you if you died. All right. So that's what we call a pure endowment. So my product I was showing you is a pure endowment. Anybody that dies gets nothing. Only the person alive at 90 gets any money. So it's a pretty extreme product. That's why the life actuaries at USA, no one would ever buy that. But I think it makes sense. So I don't think these are sold with that term. There's probably some products like this that have different terms that insurance companies probably push, but I don't know what titles they call them. I haven't seen it at USAA. And then joint policies. We're actually going to price a joint policy. I wasn't going to do it, but my little brother is an actuary, and I said, hey, I was thinking about pricing a joint policy in my life insurance class. He says, oh, no way they'd ever be able to figure that out. So I said, okay, so I'm going to do it. So we're going to do it. You'll see it. But joint life it can be first to die or second to die. So if it's first to die, so you have probably a married couple. If one person dies, it pays the life policy, and then the policy cancels after that. If it's second to die, the first person dies and doesn't pay out anything, and the second one dies, it pays. So the first to die is you got someone that, maybe two people, and they both have a pension. And so what you want is that one of them dies, you get the life insurance to offset their pension that they're going to lose. All right, so that makes a lot of sense. And what a lot of people do, we might do the math later. I need to set this up because this is a question. My dad did this, and with an actuary son and me as a son, he never came to us, but he had a decision to make on his retirement. He could take a single life retirement or a joint life retirement. He did single life, it would just pay him until he died. If he did joint, it would pay him until he or my mom died, whoever died second. So which gave him the higher income? One that was just on his life. All right. So if he did the joint, maybe on his income, it was $5,000 a month. I mean, on his life, $5,000, but if it was both lives, maybe it was only $4,500 a month. All right. Well, that gives you a really good financial analysis to do. Say, okay, if I do it just on his life, I get $5,000. That's an extra $500. Both lives is $4,500. So if he dies first, at least my mom keeps getting $4,500. Or we could take the $5,000 and take that $500 and go buy insurance. And maybe my mom would actually be better off putting that $500 in the insurance. All right. So we could do that kind of math, right? And see. And that's kind of what they did with buying the universal life policy. They just bought the wrong policy. But that's kind of what they were thinking. It's a tough decision. Some of your parents may be going through, well, your parents may be too young, but in a few years, your parents may be going through this retirement, assuming they have any kind of retirement. What do you do with that difference in payout? And you shouldn't just make a decision without thinking. You should sit down and do some math. And the first thing to do is go to an insurance company and see what whole life policy you can buy. How much is it? You might be better off with that. Now you have to run scenarios because it kind of depends when each person dies, right? It can get complicated math. The reason you do the second to die is to pay estate taxes and probate and all of that. And remember, life insurance can be very, very tax efficient. So it's not a bad way doing that joint, because you don't need probate and all that when the first person dies, because the entire state goes to the other spouse tax-free, so that's not an issue. So you really need all that when the second person dies. You want to set up for your beneficiaries to pay the taxes. So life insurance, joint life insurance can be a really good way because you don't know which person is going to die first or second, but at least you have the policy. What we're going to do later in class when we price it is ask the question, should you buy a joint policy or just buy two individual term policies? And we're going to talk about what's the difference in those. And you're going to discover that the difference in them is the probability that they both die at the same time. And so we'll see what that, we'll do the math. You'll see the math is pretty straightforward. So you can have all kinds of variations on the second exam. We're going to work several problems. You're going to discover we're going to do like 15, 20 problems. And after we do about 5 or 6 of them, you're going to see we're only doing one problem. What we're doing, we're changing when the death benefit's paid, if they're dead or alive, how many premium payers there are. It's really one product, just different variations. So you'll get used to that. It's actually, most students get 100 on all of that because it's kind of the same formula over and over again. You just got to make sure. The struggle some students have is how many D's do I put in there for death? When I do the life? What year is that? What's my N? You know, I get those kind of things right. And then I add another product on the exam, which is bizarre, just crazy product. No insurance company will ever sell it, just to see if you can handle the mortality table. And you'll see that students are getting better at it every semester, mainly because I'm running out of crazy ideas to throw at you. The first semester I did it, only one student got it right. And she was a finance major, not an actuary major. So the actuaries kind of got embarrassed on that one. But after that, the actuaries almost always get it right, and the finance students are kind of like 30%, 40%. But the key on that problem, you'll see when we get to it, it's going to be quite a few weeks away. The key is don't leave the question blank. Put down what you know, and if you still get the answer wrong, you get a lot of partial credits. So a lot of this is how do you handle, it's really all about ends, your time. Do I pay the life insurance in 1 year, in 2 years? Do I pay it, are the premium payers paying today, next year, those kind of things. So insurance companies can create just about anything you want. And you'll see my particular products are they're just weird products. But actuaries can handle all that. The question is, can it be sold? Is it a product that people would want and want to buy it? So anything that you can do. Now you do have to, every product you create has to be filed with the state, and in every state you sell it. So it's not like you just have approval throughout the entire United States. You have to go state by state by state and get it approved. But once you develop a product, you think there's some market out there, then yeah, you get it approved in all the states and you start selling it, and you see if there's a market. All right, so there's your life insurance term and perm. Any comments, questions on that? Is it sounding familiar, Dylan? Did you see some of this stuff?
A lot of the general lines, the other ones, is like a lot of this. It goes in a little bit more detail, but it's pretty much all the same.
Yeah, it's not too complex because they kind of know what they're selling. We haven't got the equity linked yet. We'll do that with the annuity. They kind of know what they're selling, and I think they've gotten to the point where it's so complicated. It's like, what more could we really do? It's just there's no magic to this, so they're stuck with the mortality table and the investment markets minus their expenses that are really high. It's like, what else could you do? You saw my product for Carol. I think that's a great product. That's one they could certainly sell. They just don't want to sell it. So I think where they're really missing the opportunity is people living a long time. They've gotten pretty good at people dying early. They just haven't figured a way to market that people living too long, which is, to me, is a big risk. Something unique with life insurance is participating policies, maybe on auto insurance. I know USAA pays an auto dividend, but participating policies is more of a life insurance thing. And what participating means is a whole life insurance policy can be pretty risky. Like I said, they're charging a fixed premium for the rest of your life, and they messed up, that could bring the whole company down. So what they generally do is they'll charge a little bit more than they really need. So maybe the premium should be $450 and they'll charge $470, something like that. And then over time, if they see that, hey, everything's working out right, the mortality's right, our investment returns are right, our expenses are right, what they'll say is like, we made more money than we need, we're going to pay you some of that money back. And that's a participating dividend. That dividend is completely tax-free. So it's kind of, you get some of your money back. And it is a participating policy, so you know, and it can be permanent or term. Most of them are permanent. At USA, the participating policy was their whole life policy. And they took it seriously. You might think, well, 10 years later, they made all this extra money, but they'll just keep it. Well, why should we give it back? But that wasn't, at USA, the life actuary, I remember this guy named Robert, I remember him. That was his baby. And he told them what the dividend should be, and he was like, no, that's the dividend. We made this much extra money. That's what we're giving back. And he wasn't budging off of that. We agreed up front that we're going to give this. So he was adamant. If we made more money, he wanted to give that back to the policyholders, and they did. There was no debate in the committee. They just said, yeah, that makes sense to do it. And so most companies probably do take this somewhat seriously. Now, are there participating policies that don't ever pay a dividend? Yeah, I'll talk about one of those. So the nice thing, if you buy a whole life policy, your worst case is the premium they tell you, and you might get some of your money back. So you can't do any worse than that. Universal life, you saw, you can't do much worse if interest rates don't do well. All right. Now, let me tell you. So my older brother, I should put this on the video and have him watch. I talk about him in class. My older brother is he's very outgoing, very friendly. So he has people selling stuff to him, and he doesn't want to disappoint them. And he doesn't really understand this stuff because it's just not his thing. He's smart, but it's just not his thing. So we have this deal: is David, don't buy anything unless I'm there. All right. Because I'm the mean guy who's gonna, you can blame it all on me. Oh, I was gonna buy it, but my brother said no. So that's the deal we have. So I went with them to buy a insurance company. We're going to talk quite a bit about here just in a minute. And their argument, they had this article. The article said participating policies are a ripoff. And her argument was a lot of them don't ever pay a dividend, and all this complaints. So that's what I'm telling my brother. He had a participating level term policy from State Farm. I don't know what the premium is. Let's say the premium, say, was $100. Level term, let's say, I think it was a 10-year, but I'm not really sure. But it's participating. All right. Here's the competition. Non-par 10-year level term from, do y'all want me to tell you the company? All right, I want to tell you them. I'll just put the initials. So they were telling them, you got to cancel that policy. It's a participating policy. We got this article about how participating policies are a ripoff. What would you recommend my brother do? What's his worst case with this policy? He pays $100 a month next 10 years. Could it be better than that? It's participating. It could be better. He could get a dividend. He probably won't. This policy rarely paid a dividend. That's what they said. See, we told you it never pays a dividend. What's the worst case? What's the best case here? He pays $185 for 10 years. And they sat there with a straight face telling him he needed to cancel that policy and buy their policy. Right? That's the industry we're in. And all because they had this article. The article might be right, the two policies that are exactly the same. And if the premiums were switched, yeah, I could see that. Yeah, the premium's higher, but it's participating. It's like, yeah, but participating policies often don't pay back. But this one was a no-brainer. State Farm, AA rated. This firm, BBB rated. So State Farm was a higher quality insurance company, so less likely to go out of business. That kind of adds to it as well. This is what insurance sales reps do in their sales pitches to get people to switch. That's, they're trying to churn some business there. This company pays a massive premium, massive commissions too. They're really known. They have an incredibly good sales force, what they're known for, and their sales force are teachers and firemen. And if you ever watched, I don't know if they do this anymore, but back at the time that I was talking to my brother, they had these conferences that were like Amway conferences or some of these multi-level market. Have y'all seen some of those conferences? People come in, they're screaming, there's rock music up on the stage. It was that kind of sales, very, very strong sales push. My high school government teacher sold for them. He spent one class selling us life insurance. He's supposed to be learning government, but he was selling us life. That's how passionate they are about this. But he had a good policy. It was a good price. State Farm's competitive. He actually did a good job. I didn't help him with that, but he did a good job picking a policy. He did a good job, $100. State Farm not getting ripped off. There's no reason for him to cancel that policy and switch just to lose $85 a month. The other thing I want to point out with life insurance, this is not a competitive industry. You should shop rates a lot. It is pretty shocking. It's interesting on my P&C class, P&C premiums are regulated quite heavily by the states. Life insurance premiums are not. They can charge pretty much anything they want to charge. And so the auto insurance side is pretty competitive. You go to Geico, Progressive, State Farm, Allstate, they're going to be fairly similar premiums. You're not going to see like an 85% difference in premiums. Life insurance is all over the board. So like we said last class, MetLife, USAA, these type of companies. I forgot to mention Allstate. Someone mentioned Allstate last class. So these are all high quality companies, especially on term. In fact, their term premiums, so the big companies are probably pretty similar. It's when you get to these aggressive sales firms, I mean, this firm has no choice but to charge more because their commissions are so high. They got to make up those commissions. So since they pay their sales force so much, they got to charge a whole lot more. So again, I would level term, 5 companies, make sure, get the best rate, make sure the big established firms. But anyway, that's how these products are sold. But again, it's one more level of complexity on something that's already pretty complex. And I haven't seen too many, at least at USA, participating universal life. I haven't really noticed that. There's not really a reason to have participating universal life because you have this crediting rate that you can change all the time. So it works for whole life because the premium's fixed. It could work for term because the premium's fixed. But with unbundled products, maybe there is a participating unbundled product, but I don't really see the need for it. So this tends to be for products where you have a fixed premium for several years, where the insurance company could be doing a lot better than they expected, and they want to give some of that back to the policyholder. Now, I remember some of y'all in 2020 might have gotten an auto insurance dividend. Any of y'all get that? Because what happened in 2020? People stopped driving. The insurance companies are like, wow, this is great. I mean, the frequency of accidents, good. I don't know if you're USA did, I'm sure State Farm and others did. So yeah, so accidents reduced, but the severity of accidents went up. We talked about that in my P&C class because fewer people were driving and they were driving really fast. And so their accidents were horrible, but the combination really was a windfall for insurance companies. But that really is kind of an annual kind of thing, whereas with this, it's a much more complicated process. So at USA, and I work some with the actuaries on this, you have to look at the mortality, the more people die or fewer, the interest that you made on the portfolio, and the expenses. You have to look at those 3 pieces and try to figure out. So we did really well on mortality, but our expenses are a little high. In that combination, you decided what your dividend was back to the policyholder. All right, so is there a way to compare these complicated products? And you can compare the simpler ones, especially the whole life policies. Once you get past whole life, it becomes almost impossible. But how do you compare whole life policies? So I'm going to do this quickly here. There's 2 approaches. I'm going to skip the traditional approach because it doesn't make any sense. It ignores the time value of money, but I'll come back to it afterwards. I'm going to do the interest adjusted net surrender cost index. Now the value of this, if you can find it, I've talked about AM Best a few classes ago. UTSA used to have the AM Best magazine. I don't know if they do anymore, but AM Best once a year will actually publish these net cost indexes for many, many insurance company products. If I were trying to pick a company that's, the cash value can change, all these kind of things, that's the index I would definitely use. So let's just look at it. We got this policy, we're trying to look at it, and we want to compare it to other products. We're going to look at it at the end of year 3, at the end of year 20. So this is the participating policy. At the end of year 3, we have dividends. We've received dividends of $200. But this is interest adjusted. So you notice without the interest adjusted, it's only $196. So when you interest adjust it, you add an extra $4 in interest earnings. All right. After 20 years, your dividends are $14,119. Only $10,000 ignoring time value money. All right. So the interest adjusted method takes what you received and adjusts it for interest rates. So you receive $14,119 over 20 years. Your cash value at the end of 3 years is $29.63. That's the same both ways, because your cash value is your cash value. That's already future value. After 20 years, it's $35,900. All right. That's the same whether you adjust for interest or not. So you received after 3 years and time value adjusted at the end of 3 years, you've gotten $3,163 from the insurance company. After 20 years, you've gotten a whopping $50,019. What did you pay to get that? Well, here's your premiums. These again are time adjusted. So untime adjusted, your premiums are $6,500, but when you adjust it for the interest, they go up to $7,239. So your net cost, you paid $7,000, you received $3,000, your net cost was $4,000 on a time value adjusted. So AM Best would actually report this on 20 years. Well, if you look at it 3 years without adjusting, it's only, your net cost is $3,400. It's a little bit lower. Why? Because your premiums have the bigger impact. You pay them immediately, they accumulate more interest. The dividends are kind of backloaded. You don't earn as much on them. After 20 years, your premiums accumulate to a really large number because that's 20 years, $75,000. So your net cost is $25,000. But look at it if you don't include interest. Your net cost, you've actually, in actual dollars, if you ignore time value money, you've actually received more money than you paid. You take that to retail consumer, they say, wow, that sounds too good to be true. Well, it's really not, because you're not getting interest. There's no interest, so you're kind of making 0% return. But if you assume 0% interest rates, you actually receive more from the insurance company than you pay them, and that's even with you're getting your cost of insurance covered. So that's pretty impressive. But when you throw in interest, your net cost is actually $25,000. Now these are future values. So what we want to do is bring this back to today. So what we're going to do, insurance is often priced on a per 1,000 basis, so that you can compare a $100,000 policy to $500,000 policy. So what is the cost per 1,000? So this is a $100,000 policy. How many thousands are in 100,000? 100 of them. So you take 4,000 divided by hundreds. So this policy is $40.76 per $100,000 of coverage over 3 years, or $259. Then what we want to do is bring it to today. We're going to use that future. So remember, that's a future value policy. So we're going to take, what's the present value? The present value times the future value factor gives you the future value. This is the future value. So if we take these factors, take the future value, divide it by these factors, our net cost in today's dollars per $1,000 of coverage is $12.31. So what do you do with that number? You compare it to another company's index, and it might be $14.12 or $11.10. And the lowest is the cheapest, the highest is the most expensive. So I used to look at these on AM Best. They're quite fascinating. One thing AM Best has stopped doing that I wish they had not stopped doing. So right now they'll only do this using historical data. They'll show you how these products have done. So you can't actually buy this policy. This is people who bought the policy 3 years ago or 20 years ago. This is where they are today. What AM Best also used to do was illustrations. What companies are saying that policies would do going forward. And what was really fun to do is take the list using the historical data and take the list using illustrations and compare them. And what you would discover with a firm like MetLife or USAA, they rank really high when you look at historical numbers, and it look terrible when you look at illustrations. And why is that? Because they're much more honest on their illustrations, and the fly-by-night companies are exaggerating the numbers. And so what I want is a company that ranks really high on the historical and not so high on the illustration, because I know they've done a good job historically, and they're honest. You can't do that anymore because they don't let you do the illustrations because there is so much lying going on. So it was kind of useless, but that would be really powerful. I wish I kept one of those magazines because I show it to you, because it was pretty. I was always looking for USAA, and USAA was always near the top on history and middle of the pack on illustrations. I was like, yeah, that's the kind of company I want to work for. At least they're honest. But you can look at these historically and compare them. Is it likely that a firm that has done well historically is going to do well going forward? Probably so. There's probably some reliability to those numbers. It's unlikely a MetLife or USAA or State Farm is going to do real well historically, and suddenly they're going to start ripping their customers off. Not likely unless they're having some kind of serious financial crisis. So that's called the interest adjusted net surrender cost index. I don't know if you Google that, what will come up. There's been so many regulatory changes on what companies can actually report, but that might be something to look for if you're looking for a policy. This works really, really well for participating whole life policies. It's a really good way to compare them because you get essentially everything that you need in there. Doesn't really work well for other policies, but it works well for that policy. Okay, we're kind of a class behind, so let me set up where we're going next, and you might want to do some Googling on this. What was it, Thursday or is it Tuesday? What's the night? Thursday? Thursday, yes. All right, so I want to have this debate or this discussion. Someone comes to you and say, hey, should I buy a whole life policy or just buy a 20-year or 30? I'm going to use 30-year term, which doesn't really exist, but we're going to use it. Should I buy a 30-year term or just buy a whole life? Actually, this is a real life situation. A good friend of mine was getting married, moving to Colorado, in the military. You need to buy life insurance, and he actually asked me that question. So I took the numbers and I built these charts for him. He's really proud that he's part of my class. And he's like, oh, that's so cool. He didn't end up buying any life insurance, but he's like, oh, that's really cool. And so what I want to do is take, there's two people in this argument. One of them is Art Williams, and the other one is the textbook I used to use for this class, but I stopped using it because it's so biased. So Art Williams is famous for a phrase, you may have heard this phrase before, buy term and invest the difference. Anybody ever heard that before? That's what my high school government teacher was saying, buy term and invest the difference. So I got these arguments from his website. All right, so this part, you have an exam essay on this. Unfortunately, the notes are somewhat mixed up because I didn't write the essay for you. Instead, I just took the arguments from the two groups and put them out there. You've got to organize it yourself, all right? But these are arguments he made and why you should buy term and invest the difference. And then the textbook said, no, you should buy permanent insurance. It's the better product. Why? Because the group that published that textbook makes a lot more money selling whole life than term. And so they had an incentive. So we had two incentives. Guess what Art Williams sells? He sells term. Guess how much whole life he sells? He doesn't sell it. Doesn't like to. So, and the insurance industry does make much more money on whole life than they do on term, unless you're Art Williams. Do y'all know what company Art Williams owned? I kind of gave you a hint with the initials. Let's see if they're still around. We end up the class looking for them. You ever heard of this firm? Primerica. Well, they've been all over the place. They may be a much improved firm today. When I started my career, the insurance industry hated this firm because of that buy term and invest the difference. And they had some, I think, questionable sales practices. But then they got bought by Travelers, and then Travelers got bought by Citi, and then Citi said this isn't working, and they spun them off. So it's been all over the place. So I don't know what kind of firm it is today. It might be the most wonderful firm in the industry. But I was working in a company where this Primerica was a 4-letter cuss word. because they hated on it. So I don't want to bias you one way or the other. I'm just going to tell you that there's strong biases either way. So we'll get into this argument. This is a tough question where you've got to take all these notes and you got to rework it into an essay. So let's think about that next Tuesday when we get into it.